Hey everybody, it's Pete. Welcome to today's episode of Stocks for Breakfast. It's Monday, June 15th, 2020. And based on the feedback that I'm getting, based on what I saw in the community last week, some people really got hit last week, took their lumps last week. Thankfully, in the community, that was not the case. We actually spent a lot of time talking about not trading if you didn't understand what was going on, which, by the way, is a monster part of understanding how to have a long-term growth to your account and without having massive drawdowns. Unfortunately, the market's opening up a little bit lower this morning. I guess a lot lower this morning pre-market, heading into Monday and the new weekend after the selling last week. One thing from a tape reading perspective last week is that during the big sell-off that we had, there was not a lot of volume, which in the ETFs specifically, which was really unusual for that size move. And that actually only told me one thing, and that was that it wasn't done. Usually when you see markets or stocks explode in one direction or the other, at the end of a move, when you think it's done, there's usually this massive spike in volume. And actually, we didn't get it last week. So that's kind of why we're seeing this move to the downside this morning. But here's what I want to talk about today. And it's interesting. I'm actually going to talk about a book that I want to introduce you to. It's not actually a trading book, but in my opinion, absolutely the best trading book you could possibly get. How's that for a tease, right? So the concepts, the thought processes that I want to walk you through today is very, very simple. Taking a trading loss is an acceptable part of what we do. If we're gonna be out there saying, yes, I understand what I'm doing, I'm going to put my money into the market, I'm going to accept full responsibility if a trade moves against me, that's the right way to think. But, and here's the thing, and actually I got into a little bit of an argument on Facebook this weekend with a couple of friends about the government intervention with the stock market and how that's actually led a lot of traders to have massive losses last week. I don't want to see anybody take a loss. I want to be clear about that. But the point is and I don't want to see the market go down either. I want to be clear on this so I'm not misquoted or it's taken out of context. What I do have a problem with, however, is the amount of government intervention in bad conditions leading to too many people in the stock market right now believing that the stock market can't go down and they never have to watch their portfolio or don't have to worry about their trading positions. And that is so far from the truth, I can't even tell you. But what's not far from the truth is the amount of people that believe that the market can't go down. We actually have had massive conversations with new people considering coming into the 30-day boot camp who got hit pretty hard last week. And it really came down to them saying, I thought I didn't have to watch it. And massive losses in positions last week where they kept building and building and building, fully expecting the market to bounce all the way back to all-time highs, which there's nothing wrong with thinking about that. However, only looking at one side of the street is really, I don't want to word this properly, is the easiest way to be separated from your money. Because if you only believe, this is the best way to work, if you only believe one thing can happen and you only believe that it can go up and it's just a question of how high it can go up, which is what happened for a few years, think about being near retirement and the government not stepping in that one time, and we just keep going down, 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 and all of a sudden you thought you were a year away from retirement, had all this money in the stock market, and now you're working at McDonald's because you couldn't make a decision, because you didn't want to make a decision, because you didn't think you needed to make a decision. Well, I'm here to tell you that none of us are bigger than the market, and we always need to be able to make a decision. Now, I'm not saying get out of the stock market. I'm not saying stop trading, obviously. I'm not saying that. What I am saying, though, is before you get into a position, while you're managing your money, assuming you're managing it yourself, obviously a professional money manager will have all of these plans in the first place, like they have rules, right? You need to know, if you're going to have the guts to get in there and manage your own capital, you need to know where you're getting out before you get in. you need to know what that trade needs to look like. And there's that dirty word that nobody likes to use called discipline. Ooh. But discipline is nothing more than having a plan for what you're going to do and actually doing it, which means that whether it's simple moving averages, whether it's trading lower than last Monday's low, if you're holding a trade from 1 week to the next or 1 month to the next, it could be as simple as that. There needs to be parameters that you say to yourself, I know exactly what I'm doing in both directions. I'm going to let my profits go. I'm going to be slow to book my profits. I'm going to let them go, 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 which was very easy to do for a long period of time. But what happens if it turns around? Again, I actually got a nice email from somebody late last night about why I don't have moving averages on most of my charts. And it's really because I like to work the charts. If you've been a regular follower of the channel, which by the way, please subscribe if you find these videos helpful. If you've been a regular follower, you understand that what I do is called tape reading, and it really comes down to, I want to dig into the charts. And sometimes when you're looking at moving averages, you tend to not pay attention to as much. You tend to just say it's above or below the moving average, and that means X. And I really like to dig in, because what happens sometimes is you start to see where it's above the moving averages, but maybe the stock is going sideways for 2 weeks, but you don't notice it's going sideways because you just see it's above the moving average, and you end up putting on trades where there's no chance of making money because it's stuck, and you need to see it get out of that range. So that's why I don't have moving averages on my game planning charts. I do know which moving averages are out there, because once I do all my game planning, then I go back into and I say, is the market or the stock coming up to any significant moving averages that might be a self-fulfilling prophecy that a lot of people watch, such as the 200 period, the 20 period, the 50 period. Those are the three main ones that I pay attention to. But how does that come all the way back to what I want to talk about? That comes all the way back to, and this has to be your mantra, trading losses are a business expense. Trading losses are part of what we do, and it's 100% okay to take a loss on a trade. And I did that in Boeing last week. It was a stock that I really, really liked. On a pullback, I bought the stock, took a small loss, the stock bottomed out, and then I made the money back the next day. That's real trading. Real trading is you put on what you believe is your best educated guess, what you believe is your probable outcome based on your strategy. And then if it moves in your favor, terrific, you learn how to manage winning trades. If it moves against you, though, you have to get out, or at the very, very least, and this is a really advanced tactic, for lack of a better way of putting it, but it's really not that difficult. Anybody could really do it, is if it moves against you and you still like the idea, just go from 500 shares to 200 shares. There's no rule book that says you have to get stopped out for your full amount. So if you're in a trade and you get this one big candle to the downside, or I'm just using candle as an example, because that usually scares somebody out of a position, there's nothing wrong with going from 500 shares to 200 shares, 300 shares to 100 shares, 1,000 shares down to 300 shares. It's our job to manage risk until those trades start to move in our favor. Then we're managing leverage. Then we're adding to the trade. So just think about that losses have to be a part of your mindset, and that you're not trading scared. You're being disciplined. You're doing what it takes to see your account grow. And I've said this over and over and over again. Once you manage your losses, then we learn how to manage winning trades together. But if you don't manage your losses, you're not going to have money to be around long enough to learn how to manage your winning trades. Now, I know you're going to write to me and say, well, I could just refund my account. But why the hell would you want to do that? Why not just do it right from the beginning? So the book that I want to talk about very briefly, and then I'm going to get into a very quick PowerPoint, is this book. It's called Mindset by Carol Dweck. And I'll save you all the whole thing, but first I highly recommend you pick it up, and here's why. The main theme of the book is that all of us live life from a growth mindset or a fixed mindset. A fixed mindset means that you only see things a certain way and you don't change how you view it. Like you're so fixed in your thought and your belief, you're not open to any other possibilities. A growth mindset means that everything that happens to you, life becomes this magical place where everything is a lesson for you, and that's how you grow as a person. But specifically as a trader, if you take every single trade with the concept of the thought process that you're going to grow from every single situation, you're going to pay attention, which a lot of people don't do. They just go from trade to trade to trade to trade. Don't pay attention to what they did or the results. What you did, by the way, is more important. When you pay attention and you have the growth mindset, every single trade becomes a profitable lesson, whether you made money or not, because you could say, I did what I was supposed to do. I didn't do what I was supposed to do, and I'm going to learn from that and be better. Even profitable trades are really the biggest lessons, because you can actually say to yourself, and I say this all the time, it's your winning trades that are the cause of all of your stress. It's your winning trades that are the reason that your account's not going like this, because there's certain days when the market is really, really good to trade. And you need to know days, weeks, months. We had a period of almost 2.5 months where the market went vertical, and people were in the community were making really, really good money. And I'll give a shout out to Nick, who had an amazing couple of weeks there. You need to make what you're supposed to in those periods of times, so that when the market's slow or doesn't make sense, which it doesn't for a lot of people right now because we're going down, it'll be a lot easier for you to be in cash and just sit back and say, I don't understand what's going on. I made what I was supposed to, when it was easier for me to spot what was going on. And that's a big part of trading, because, and me, myself as well, in the community, everybody's like, I don't understand, you're not trading more. And I'm like, well, if it doesn't make sense, I'm not going to trade. And that's experience. That's stuff that you can't get. You're not going to get that in a trading book. I got hundreds of trading books here. You're not going to get that in a trading book. You need to learn that in real time while we're trading together. And that, honestly, that's the whole point of the boot camp. The whole point of the boot camp is learning how to not lose money, so that you can really get to the point where you have conviction, and then we work on those winning trades together in real time, as well as swing trades. So anyway, that's the points that I want to make, is you need to understand where you're going to get out of a position prior to the position happening. And if and when the market pulled back like it did last week, you were prepared. You were absolutely prepared. Now, were some of those losses ugly? Did it happen quickly? Yeah. But here's the thing. Some people right now are devastated and frozen, as opposed to saying, okay, I didn't expect that to happen. It wasn't a part of the plan. That was a pretty big pullback in one day. That's a part of what we do. And the same thing where just the week before, it was like a market party where we were just exploding to the upside. Both sides of the equation can happen at any time. So if you took your lumps last week, it's very, very important for you to say to yourself, I'm going to use a growth mindset. Again, I don't get any credit for the book, but I recommend you pick it up. You have a growth mindset, and you say, how can I learn from that to prevent that from happening next time? And yes, I'm sure somebody's going to leave a comment that says, well, you can't predict what a big down move is like that is going to happen. No, but what you can do is decide when you're going to book your profits. And I called it last week. Early last week, I said, go back to last Monday's video. I said, I'm expecting profit taking coming into the market this week. The prior Friday, I said it looked like a party was going on when the market exploded to the upside, and it's on video. Go and watch it. And it was one of those tape reading from experience perspectives where I literally came in on Friday afternoon in our community. I said, this is a party. We're going to have a hangover next week because of the price action and the exuberance to the upside. And sure enough, last week we got clobbered. I didn't predict it. That wasn't lucky. That was just having experience to understand how to read the tape. And that's the difference between chart reading and tape reading. If you don't understand the difference between the two, you absolutely have to go and find out what's in the boot camp. I mean, for the cost, for the investment of experience, it's really just a no-brainer. So anyway, I'm going to go over to, we're going to just do a very, very quick screen share here. And we're going to discuss and bring this point home. So some thoughts on discipline, right? Discipline is the ability to follow your plan, and that assumes you have a plan in the first place. If your plan has an edge, it's a matter of following it to make money and following it over time. If you're a regular subscriber, you know that over time is a big deal. It's easier said than done because most traders trade from ego and emotions. And ego and emotions in this case is greed. At some point, if you're an active trader, I'm not talking about investing, holding stocks for years. I'm talking about an active trader. You need to have profit targets or percentage gains that you feel are, okay, that's really, really good. I'm going to start to trail my profit and then look for another opportunity if I get hit. The only reason not to take a predefined loss is because you are trading to prove your analysis instead of trading to grow your capital. Now, I'm going through this a little bit quickly because I want to get to this bright side here, which is important. Discipline applies to all of these things. Most people mistakenly believe that discipline only applies to being disciplined on trading losses, and that is wrong, and I'm going to show you that right now. So first, it does apply to trading losses and booking profit, but also which stocks to trade, how to manage risk in each of those stocks. Which stocks to trade is a huge confusing thing for far too many people. They believe that they should be trading penny stocks. They believe that they should be trading $300 stocks. You know what? Pick stocks that you could manage risk in. Pick stocks that you have that have liquidity. Pick stocks that have smart money activity with consistency. It's why I don't talk about penny stocks. Penny stocks and penny stocks in the truest sense. I'm not talking about publicly traded companies that are on the big board, the New York, the NASDAQ. I'm talking about literal penny stocks. For those of you that don't know, penny stocks are penny stocks, and they're not required to report what they're doing. They're not required to report their earnings. Why trade something that doesn't have to tell you what they're doing? You're only trading penny stocks because you have X amount of money in your account and you want to buy 1,000 shares of a stock that's 20 cents. Which stocks to trade should be stocks that are publicly traded in a way that they have volatility, volume, profit potential that matches your risk, your resources, your training, and your skills. So which stocks to trade and when to trade them is very important. So when to be aggressive and when not to trade. And again, this last part is a huge thing. We saved a lot of money for a lot of people in our community last Friday because people were anxious, wanted to do something, but also admitting that they didn't understand what was going on. So I coached everybody through last week. I was, look, there's nothing wrong with being in cash. Next week when the market settles down or picks a direction that's obvious, we'll be in cash and we'll be able, without having to make back money we threw away. So when not to trade is just as important as understanding what I said before about your wins. Your profitable trades are the reason that you're not making enough money or growing your account because you're not earning enough on the days that you should be aggressive. Managing hope, fear, and greed. And again, greed is a relative term, but I will tell you this: hope kills more trading accounts too, because you hope your losses come back, and that's the fastest way to be separated from your money. And the last part here: doing your homework, being prepared for the day, being prepared for the week. I can't stress enough: every time you enter a trade, before you enter the trade, you need to know what you plan to do on both sides of the trade. It's very, very important. So anyway, if you find these videos helpful, absolutely click down and subscribe. Share the videos with your friends too. That would be really something I'd appreciate. But here's the most important thing. Trading can be the most exciting experience of your life, specifically stock trading, right? Just please do yourself a favor. Anytime you're about to buy or sell a stock, meaning if you're going to sell it short, but most people buy, write down in a journal. Just get a little $1 notebook and say, I'm buying this stock here. Here's where I plan to get out if it moves against me. Here's what would be an acceptable profit to me. And if it gets up to that level, I will consider scaling out, trailing it, or maybe even just getting out. You will be amazed at how often you're right in your plan, but how infrequently you actually follow it. And then the more you start to see how good you are, then you start to really feel like you're owning and taking responsibility of your results. So anyway, that's today's episode of Stocks for Breakfast. I know some people took their lumps this week, so hopefully today just gives you a little bit of structure to understand that taking a loss is a part of what we do. It's controlling those losses and being okay with accepting the fact that losses are a part of what we do. That really, really helps you take control of what's going on in your trading account. So have a great day, everybody. I'll speak to you soon.